The world's top 65 banks committed a massive $869 billion to fossil fuel companies in 2024.
Welcome to the debate. Today, we're diving into, well, one of the starkest contradictions in modern finance. For the last 5 years or so, environmental, social, and governance, or ESG investing, has gone completely mainstream. I mean, it's captured trillions in assets and received this unprecedented regulatory focus. But running parallel to that, we're seeing a relentless surge in high-profile greenwashing scandals, fundamental financial fraud, and a wave of banks publicly abandoning their core climate commitments. It just doesn't add up. So we have to ask, does this wave of institutional backpedaling and, frankly, deception expose ESG as a deliberate greenwashing tool, a kind of sophisticated distraction? Or are these issues just, predictable growing pains in a complex and rapidly changing space?
That framing really does cut to the heart of it. From my perspective, the persistent financial data, specifically this massive commitment of capital to carbon-intensive industries, combined with the strategic backpedaling, it proves a pattern of systemic, profit-driven deception. The actions of major banks strongly suggest they're knowingly using ESG rhetoric to attract capital while, designing policies that ensure business as usual just continues under the surface. It is, I think, the very definition of intentional misdirection.
And I'll be arguing that while the outcomes are, yes, deeply troubling, blaming all of this on pure institutional malice really oversimplifies the enormous practical and political challenges here. I think these issues reflect the immense intrinsic complexity of translating these broad, qualitative concepts like sustainability into standardized, measurable metrics, all while under just intense political and regulatory strain. The challenges are structural, they're political, and they're definitional. And that often leads to inconsistency, not necessarily outright fraud.
Okay, so the evidence for systemic deception, for me, is right there in the staggering disconnect between public pledges and the actual flow of capital. This is exactly what banks don't want you to see when they're marketing their so-called green funds. The fact is, the world's top 65 banks committed a massive $869 billion to fossil fuel companies in 2024.
That figure, it's a $162 billion increase from the year before. And what's truly damning is that $429 billion of that went specifically to funding expansion projects, new pipelines, new drilling. I mean, this surge in funding years after these same institutions made these big, splashy net zero commitments, it makes those voluntary policies feel like, empty promises. They were designed for marketing, not decarbonization. And what's more, the moment these pledges became even slightly inconvenient, politically or financially, major institutions just retreated. Wells Fargo, a key player, simply scrapped its 2030 and its 2050 climate targets. Just gone. We also saw the effective collapse of groups like the Net Zero Banking Alliance, the NTBA, which saw banks withdrawing left and right, citing political friction. The intent here seems pretty unambiguous. Prioritize short-term profits and political expediency over genuine climate risk management, and just use the ESG rhetoric as a temporary cover.
I absolutely understand the gravity of that financing data, I do. But let me offer a slightly different perspective on the underlying causes. If this were all based on a simple systemic deception, I don't think we'd see the specific nuances of the complexity or the corrective enforcement actions that are starting to pop up. The failures, I would argue, are often rooted in a kind of structural friction. ESG metrics, unlike a PE ratio or standardized balance sheet data, they're inherently qualitative. They're trying to quantify subjective goals. In this space, it just lacks a globally standardized accounting framework. This foundational inconsistency leads to, huge rating divergences. You can have one rating agency that's laser focused on governance, the G pillar, and another prioritizing environmental factors, the E. So they give completely different scores. That confuses investors, sure, but it doesn't automatically mean there's this centrally directed fraud across the whole market. And the institutional retreats you mentioned, they are so heavily influenced by external constraints. Executives now identify federal policymakers as the #1 source of ESG opposition. So when BlackRock rolls back a commitment to get off an anti-ESG blacklist in, say, Texas, That's a strategic reaction to political risk, not necessarily proof of internal malice. And crucially, when deception is provable, regulators are stepping in. The SEC fined DWS Investment Management $19 million for misleading statements about its ESG engine, and another fund, Active Super, was fined $10.5 million for greenwashing. The system is starting to establish boundaries.
But I have to challenge that notion that these are just structural complexities. That perspective, I think, it really minimizes the element of deliberate policy design. I mean, this is what the banks are using to manage these funds. We need to look past the vague E-metrics and get to the foundation, which is governance. Governance failures are the very mechanism of this crisis. We're not just seeing greenwashing, we're seeing endemic financial fraud inside firms that are at the same time marketing their high governance standards. Think about the examples you brought up, Wells Fargo's account fraud, Wirecard's phantom cash. These exposed massive gaps in basic internal controls. And now, look at how ESG amplifies that risk. The co-founder of Aspiration Partners, a firm that built its entire brand on being fossil fuel free, was accused of just fabricating assets. So if the G pillar, basic transparency and control, is failing that spectacularly, then the entire ES structure built on top of it is just meaningless window dressing. It's designed to attract capital under false pretenses. We're not just seeing greenwashing, we're seeing endemic financial fraud inside firms that are at the same time marketing their high governance standards. Think about the examples you brought up. And your point about regulatory action, it ignores how these financing mechanisms are intentionally designed. The $869 billion figure exists because of these loopholes. 70% of that expansion financing came from banks with public exclusion policies. How? Well, they relied on corporate-level lending, which was 94.7% of all transactions to fund expansion indirectly. It's a calculated choice that lets them profit from high-carbon industries while keeping up a green facade for their investors.
I see that point, and it's a serious one. But we do have to be careful not to conflate historical, generalized financial malfeasance with a failure of the ESG concept itself. The Wells Fargo scandal, for instance, that broke in 2016, that really predates the mainstreaming of ESG as we know it today. So while a weak G pillar absolutely undermines an ESG claim, the issue is that general fraud has, well, it's always existed in finance. The question is whether ESG made it worse or if it just became another area where those pre-existing weaknesses were exposed. And regarding the loopholes, yes, they're clearly being used, but they also underscore the immense difficulty of technical implementation in a global market, not just pure malicious intent. It highlights the core problem of defining materiality. When is a loan to a huge diversified company material to its fossil fuel expansion? These are tough legal and accounting hurdles.
And we should also acknowledge positive counterexamples. You have institutions like ING Group that have successfully tightened their standards, and they've slashed their annual fossil financing. And the market is adapting. High-intensity ESG controversies like an oil spill or a big scandal, they now critically adjust a company's ESG scores downwards. The market is getting better at pricing in the financial risk of these ethical lapses. And shifting from the flow of capital, let's talk about the integrity of the data itself. This is central to my argument that this is a structural problem of measurement. The sheer divergence in ESG ratings makes it almost impossible to assign blame solely to institutional deception. I mean, how can we honestly label a fund deceptive when two highly respected rating agencies can look at the exact same company and come to, radically opposite conclusions about its ESG credentials? One agency, maybe ISS, might focus heavily on governance, giving a high score to a firm with a great board structure. Meanwhile, S&P Global might emphasize environmental metrics and give that same firm a poor score for its carbon intensity. This divergence is intrinsic to the subjective, qualitative nature of the concepts. And these priorities are influenced by culture. Western analysts might prioritize climate change, while analysts in emerging markets might put more weight on poverty alleviation or anti-corruption efforts. The lack of standardized global accounting principles for this data, it just fuels confusion and creates this space for mixed outcomes that are very hard to police as intentional fraud.
I understand the structural argument, I do, but I would frame the result very differently. That methodological confusion, it actively serves institutional interests by creating what I'd call regulatory opacity. The fact that so many rating providers don't fully disclose their methods, and instead they rely heavily on self-reported data from the very companies they rate, creates a system that is just ripe for abuse. That data is so susceptible to selective disclosure, to what we call claim greenwashing. This intentional opacity is precisely how banks leverage the complexity you're describing. It becomes a shield. It ensures that investors who are relying on a single favorable rating or banks marketing funds based on whatever rating looks best are easily misled. You mentioned the market is incorporating controversy, but that impact is slow and it's uneven. Research shows that companies hit with severe ESG controversies still underperform their peers by 2 to 5% annually, which suggests the rating system allows investors to hold significant risk without getting adequate warning. This breakdown in trust isn't a benign side effect of complexity. It's a mechanism that benefits the institutions that profit from the ambiguity. And I'm still just not convinced that regulatory action and growing pains fully account for the scope of this. We have to go back to the voluntary retreats by these global banks. That to me speaks to an intentional choice to prioritize profit. The collapse of the NZBA, the quiet abandonment of these big environmental standards projects by JP Morgan, Citi, Wells Fargo, that was a conscious strategic decision. The political pressure you cite, yes, it certainly exists. But their response just shows how fragile their initial commitment really was.
If managing climate risk were truly seen as a core fiduciary duty and a foundational risk strategy, which is what they claimed a few years ago, it would withstand routine political shifts. Instead, this rapid backpedaling signals to the market that their commitments are temporary marketing tools, subject to any shift in the political wind. The moment the cost of the promise exceeds the immediate marketing benefit, they walk. That behavior is the clearest signal of deception I can think of.
But we can't ignore the practical realities of managing these massive institutions under direct political assault. Executives themselves say federal policymakers, not activists, not market forces, are the leading source of ESG opposition now. That's a dramatic shift. So to survive and protect shareholder value, they had to make strategic adjustments. This is what led to this phenomenon of greenwashing, where companies reduce their public ESG branding while strategically retaining their underlying sustainability goals. They're shifting away from the political liability of the label, but maintaining the work improving governance, refining data, strengthening supply chains. That isn't the same as total abandonment. It is a strategic response to protect the firm from political risk. We can't just conflate strategic silence with a genuine abandonment of the actual work.
But if the underlying goals are still there, why abandon the public accountability that the NCBA provided? Greenwashing only works if investors can't verify the claims, which just reinforces my point about opacity. It lets firms keep the internal benefits, like better efficiency, without the public accountability for the net zero targets they promised. If they were serious, they'd maintain the commitment and lobby against the pressure, not just capitulate. This choice shows they prioritize political peace over planetary commitment.
That assumes the political climate allows for that kind of lobbying without catastrophic retaliation. The financial sector is navigating these unprecedented politicized constraints, and the capacity for robust internal work is still strengthening, which is itself evidence of progress. We are witnessing a very painful transition where the market is learning to price political risk into sustainability. This struggle to impose structure and accountability on a complex domain, it doesn't mean there's no fraud, but it stops us from labeling the entire system a monolithic deceit.
So the debate really keeps coming back to this. Is the bank's behavior fundamentally duplicitous, or is it just structurally flawed? The quantitative data, the $869 billion in fossil fuel financing, the widespread policy loopholes that prioritize corporate lending, the rapid abandonment of collective climate action, it all strongly suggests that for many major financial institutions, ESG has been primarily an opportunistic label, a marketing tool to attract capital while they continue business as usual, just beneath this thin green veneer. This manufactured opacity, it undermines trust and poses a real systemic risk.
And I maintain that the inherent ambiguity of these qualitative metrics, coupled with the intense, destabilizing political backlash that forced firms into greenwashing, makes it overly simplistic to conclude the entire system is designed for fraud. The struggle is to impose enforceable, measurable structure on this qualitative domain. And the evidence of active regulatory enforcement, those SEC fines against firms like DWS, it demonstrates that the system is trying to establish accountability. So investors, well, they must become more sophisticated navigators of this complexity, rather than simply assuming they're victims of a single deceptive score.
The source material, I think, clearly demonstrates that the journey toward genuinely sustainable finance requires everyone to look past the marketing terms and rigorously examine the quantitative data, the actual capital flows. The scale of the money flowing to expansion projects alone should be enough to raise very serious doubts about institutional intent. There is, without a doubt, much more to explore here.